Hi, my name is Kellie Wood and I'm the Head of Fixed Income at Schroders and Fund Manager of the Schroder Fixed Income Fund. Today I'll update you on the September quarter, including our market outlook, portfolio positioning and performance. The third quarter delivered some strong performance across global markets, and that was really driven by the US, with growth holding up, inflation remaining contained and the US Fed easing policy rates. You can see on the left chart, US GDP for Q3 in blue, printed at 3.8%, with personal consumption expenditure in green driving a lot of this growth. The US consumer has been supported by wealth gains and lowering of their savings rates. Couple this with the US Fed restarting the easing cycle post some weakness we've seen in the US jobs growth, and the odds of US recession have fallen to 5%. This all comes at a time when the risks to inflation are tilted to the upside. The US economy, according to the CBO, is growing close to 2%, above potential. On the left chart, the blue line, which leads core services inflation, suggesting there is upside risk to inflation with the US economy growing well above potential. Leading indicators on the right, like the US manufacturing output prices, are also suggesting upward pressure on goods prices. The real risk here is that the US Fed continues to cut the cash rate into this rising inflation environment. The market will see this as a policy mistake, and our forecast is for the US Fed to deliver 2 more rate cuts to a terminal rate of 3.75%, and then hold at this rate through most of 2026. Compare that to what's priced in the markets, which is a 3% policy rate, and we believe there is too much price for Fed easing over the next year. In Europe, we believe the ECB is already at terminal rates at 2%, which is already in line with market pricing. Inflation has been moderating and growth is slowly accelerating. In the UK, we believe the Bank of England is also at terminal rates, with sticky services inflation that really has not moderated. In Australia, the RBA could deliver us with 1 more cut, with leading indicators of inflation suggesting inflation isn't moderating as fast as what the RBA forecasts, and growth leading indicators are starting to accelerate closer to 2%. Our cash rate model suggests a terminal rate of 3.3%, which is only 1 more rate cut over the next year. So what has this outlook meant for markets over the last quarter? Well, Australian bond yields have been trading in a range, but they actually finished higher in the September quarter, while US yields have fallen as the market has pulled forward that easing path of the US Federal Reserve. Credit markets have continued to perform strongly, outperforming government bonds, with continued compression in credit spreads, both in Australia and US investment grade and high yield markets, where Australian credit has really outperformed global credit markets over the last quarter. Year to date, we have continued to see strong returns across all fixed income asset classes as growth has held up and inflation has moderated, and central banks have been cutting interest rates. Year to date, we have seen outperformance of Australian bonds versus global bonds, and Australian credit outperforming global credit. But the star performer in global fixed income has been emerging market debt, with 13% year to date returns, with higher structural sovereign yields declining, a lower US dollar and the US Fed cutting rates driving this strong return in local currency emerging markets. We continue to see attractive yields across the global fixed income universe, with all fixed income asset classes yielding above cash and term deposits. We're preferring bonds over cash and earning high quality income in asset classes like Australian credit, European credit and emerging market bonds. The key theme running through the portfolio that has continued into the third quarter is the preference to be owning Australian fixed income assets over global fixed income assets, with 84% of the portfolio in Australian assets that have performed strongly in the September quarter, and 16% in other regional exposure. The portfolio is well diversified across sectors and markets, with 42% in Australian government-related assets, where we prefer to own longer dated semi-government bonds with attractive valuation and yields of 4.5%. We have reduced our credit risk, with 35% of the portfolio now held in corporate bonds, preferring Australian and European investment grade credit, where we're seeing more attractive valuations and a more supportive cycle, compared to the US market, where we remain short US investment grade and US high yield, given very expensive valuations. 12% of the portfolio is held in securitized assets in Australian AAA residential mortgage-backed securities, with yields of 4.5%. That has performed well, given attractive starting valuations alongside the RBA easing policy. We continue to hold a 5% allocation to emerging market debt, with yields around 9% and the remaining 7% of the portfolio in cash equivalents. In rates, we remain short duration versus our benchmark, preferring to own emerging market duration versus developed market duration, given we believe too much easing is priced into both the US and the Australian rates market. The fund has a high credit quality of AA- and a yield to maturity of 5%, some 85 basis points above our benchmark, assessing those high levels of income in the fixed income space. The fund has delivered a strong absolute and relative return of 60 basis points over the benchmark for the quarter. This excess performance was delivered via high levels of income and rates and credit performance. Over the medium term, the fund continues to deliver on our objectives, outperforming our benchmark by over 100 basis points over 3 years. The fund is well set up to capture dispersion in fixed income asset class returns while maintaining that resilience in a changing macro environment.